Coming up in today's episode, the NASDAQ posts the best first half performance since 1983. The market reacts well to soft inflation numbers. What history tells us about the likely performance in the second half of the year. Apple becomes the first $3 trillion company. The SEC pushes back on Bitcoin ETF filings. And dark pool traders and insiders continue to sell into this strength. Hey, what's up guys? Happy Friday or Saturday, wherever you are in the world. It's Jared here, and quite a bullish day to finish out the week, month, quarter, and first half of the year. Got green across the board here, just a few pockets of red in Nike and Micron, and we even saw the defensive sectors, utilities, consumer defensive, and healthcare have a good day. And wouldn't you know it, especially mega cap tech with Apple up 2.3% and NVDA up 3.6%, which I'll get into on the charts a bit later on, so stick with me today. I've got a really interesting show for you. And so technically speaking, it was a strong day to finish out the first half of the year. We didn't appear to get that overwhelming selling caused by huge portfolios that need to rebalance out of stocks and more into bonds. We still may see that next week. However, today it was pretty bullish moves on some strong volume as well, with SP500 found new year-to-date highs above 44.50, and the market started strong, gapped up, held, and finished near the highs, with all indices putting in a good performance. Here's the equal weight S&P 500. There's the Qs gapping up on volume, couldn't take out those highs from 2 weeks ago, and same with the Dow. Mid caps actually broke out, Russell still not quite there, and micro caps as well a bit weaker. And just look at that price action in Apple. Gapped up, held, finished near the highs on huge volume, 85 million shares, and we're now over 3 trillion market cap for the first time ever. And the largest company in the world has gone parabolic. Look at this tight uptrend we've seen, and the momentum in this is just so strong. Looks like it just cannot be stopped, and it seems the market doesn't even care that their latest quarterly results had both revenue and income down on the year prior. And like a few other mega cap techs, their growth appears to be stalling out, but the market doesn't seem to care about that at all. And so what these two guys created more than 40 years ago has grown into the monster that we all know today and seems to be currently unstoppable. And what really helped the market today was the key Fed inflation. The core PCE price index increased 0.3% for the month, and spending rose just 0.1% for the month, below the estimate of 0.2. So not a huge beat, but does show inflation is softer, but also that consumer spending is coming down as well. And so this is kind of the Goldilocks scenario that the market is getting excited about, that inflation is coming down. The Fed may only have one more hike left in the bag and finish up their hiking cycle, and the economy is stronger than expected, and of course all the buzz and hype around AI. And that's why we're starting to see headlines like this: the US could see inflation drop like a rock without hitting a recession. And that's given a lot of people confidence to call this a new tech bull market, and we should expect strong second quarter earnings to add more fuel to the rally, and stocks should keep going up until Christmas. And looking throughout market history, there is a bit of data to back that up. And so in the first half, the S&P 500 jumped 15.9% for the year. And historically speaking, whenever the S&P 500 is up 14% or more in the first half, the second half will see an average of 4.2% gain. And that's on data going back almost 100 years to 1929. However, some on Wall Street are a bit skeptical of that happening again, including long-term local on the New York Stock Exchange, Art Cashin, who says this is a sediment-driven rally and a bump in the road could turn out to be a landmine. And he said, short of going absolutely parabolic, this has been some dramatic pyrotechnic run on this rally. But he said that will mean small future challenges could have outsized market reactions. And I think that's true now. The market's becoming priced for perfection, so any small surprise could really upset the rally. And he went on to say, I can't overstate how strongly sentiment has taken over. And he too predicted the Fed won't reach their 2% inflation target until at least 2025. And he said higher rates are not really in anybody's plan. If they're going to move significantly higher, everything could change. You could go to negative payrolls and whatever. But for now, the sun is shining, the Roman candles are bursting, and everybody's happy. And that is no doubt true. We can see that in the options market. Another busy Friday, 42 million contracts traded, and still record amounts of call options as well, 58% of calls. And we can see that almost half of all option activity is done by small and retail traders. And basically, as more small and retail traders buy call options, the option dealers that sell those calls, they've got to delta hedge their position, and they've got to do that by buying the stock. So the more people that buy calls, the more the dealers have to buy the stock up, creating what's known as a gamma squeeze. However, you look underneath the surface, sophisticated dark pool traders, and that's trades that are done off the exchange. So you could think of the exchange as being lit, and that means lit up so you can see the trades are done on the exchange. Typically larger traders, hedge funds, and the like, they'll do their trades off the exchange in private pools and exchanges, and hence the word dark. And so this blue line here represents that level of buying activity in dark pools, and we can see as the S&P 500 here in the green line has crept higher the last couple of weeks, dark pool buyers have actually pulled back their buying going into that. And over the long term, just like corporate insiders, they have a pretty good track record of timing the market, and quite often they're contrarian in their moves. And so since mega cap tech has absolutely crushed it year to date, we can see the moves here. Apple up almost 50%, Microsoft 42% year to date, NVDA 189%, even Amazon 55%, Meta over a double year to date, Adobe and Oracle up 45% year to date. The corporate insiders are not dumb, and they are selling into that. We have seen a lot of mega cap tech corporate insiders selling huge amounts this last month or so, and we saw that again today with the founder and chairman of Oracle, Larry Ellison, one of the top 10 richest people in the world, who's seen his stock climb 45% year to date. Here's a monthly chart of the stock. He just recently exercised some call options and offloaded a huge $847 million worth of stock. And this just comes after the CEO of Oracle offloaded almost $500 million worth of stock back in mid-April as well. We've seen the same thing in NVIDIA ever since we had the pop-up after earnings. Corporate insiders have offloaded about $200 million worth of stock. We've seen a few insider sells in Apple as well. Even CEO Tim Cook offloaded almost $10 million worth of stock. Same thing in Meta. As the stock stripped higher this year, corporate insiders have sold all into that strength. And again in Netflix, founder and chairman Reed Hastings offloaded almost $19 million worth of stock recently too. Same story in Google and also in Tesla. So just looking at the NASDAQ on the weekly chart here. And so we've been in this kind of parabolic move now for a couple of months. And it's no surprise a lot of people are calling this a new bull market. However, the richest people in the world that actually run these companies don't seem to agree. And they seem to be doing a lot more selling than buying. However, the most of the market is ignoring all that because we seem to have the fear and greed index stuck in the extreme greed zone here at 80. And that's the most elevated it's been for over a couple of years. You can see the fear and greed here in the blue line. Pretty much spent the entire month of June really elevated above 70. And looking back over the last couple of years, typically when we go over 65, 70, it kind of just spikes and comes back down. And that's normally associated with short-term tops in the market. So we can see the S&P 500 in the red line here. And our own market sentiment indicator, the S&P 500 oscillator, is showing the same thing. Pretty elevated here at 63 today. And looking back in history, these levels are typically associated with short-term market tops when we see our indicator get this elevated. And so a lot of data goes into this indicator, not just technical. It's looking at market breadth, options market activity, volatility, retail sentiment, a lot of things to kind of give you a reading on where the market is and when it gets overbought and oversold. So right now it's been persistently overbought, similar to the fear and greed index. And we can see the same thing in our sector trends table indicator, just a lot of green across the board. So this custom indicator of ours shows you where each sector is in relation to the 5, 20, 50 and 200-day moving averages. So it gives you a bird's eye view heat map at all the trends in the market. And we're only red across the board in utilities and regional banks. Most other sectors are in uptrends in their immediate short, medium and long-term trend. And we can just see that here on this weekly chart of the NASDAQ. We're now up 45% since we hit those lows back in October. The market has not done a decent pullback for over a couple of months now. And we're just currently sitting at these levels where we peaked out in March last year. So me personally, I'm not calling this a bull market. I know a lot of people say when the prices jump more than 20%, it's a bull market. However, in my mind, a better definition of a bull market is, has the price reached an all-time high within the last year? And so even the NASDAQ is still not at all-time highs, and neither is the S&P 500. We peaked out at the start of last year at 4,800, so we're still a couple of hundred points off that. And the equal weight S&P 500, I would still call a sideways market. Same with the Dow, mid-caps, small caps Russell are still pretty weak, and micro caps are only just off their bottom. And these indices represent a lot of stocks out there. When you look at the NASDAQ and the S&P 500, that's pretty much the magnificent seven, those top 7 stocks, the Apple, Microsoft, NVIDIA, Tesla, that have pretty much driven most of all those gains this year. So it's been quite a skinny bull run, if you will. And if you would like to get lifetime access to all my custom indicators on TradingView that I've developed over the last 9 years, then head on over to my website, clickcapital.com. NVDA.io/deal. And you'll find this page here, and time's running out on this special offer. Just 2 more days left. It finishes at midnight New York time on Sunday, and you can get 50% off all of my indicators as one package. So that's lifetime access to all 20 of my custom indicators for just a one-time fee of $197. All you need is a free TradingView account. Just come to this page, enter your email, TradingView username, safely check out, give us a few hours, and we'll give you access to all of my indicators with no ongoing costs. And that's a 7-day money back guarantee in case you change your mind. And you'll also get access to any future indicators I bring out as well, 100% free of charge. And I do have some really cool stuff in the pipeline. Indicators that you've never heard of or seen before, like the ones we already offer here on this page. So if you don't want to be like everyone else and just using the free basic stuff like RSI and MACD and what everyone else is using, and you want to use some cool custom indicators, then I highly recommend you take advantage of this deal, as I'm probably never going to sell all my indicators for this cheap again, as I've put hundreds of hours into making all of these, and I use them every day myself to run all of my own portfolios. Jumping back into the major news headlines today, and the SEC has pushed back on those applications from BlackRock, Fidelity, and a bunch of others, trying to get the first spot Bitcoin ETF into the market, and they actually said that their applications aren't clear and comprehensive. So it's still yet to be seen whether the SEC will approve these applications for these ETFs. And it was that news that BlackRock did partner with Coinbase as the custodian for that new spot ETF back here that quickly pushed the price from the low 50s up to the low 70s where we are today. However, we've put in a bit of a reversal candle here. You can see prices above our buy-sell band. The DSI is in overbought territory, and so we may pull back from here as the market prices in a good chance that this might not actually go through, because the SEC is still suing Coinbase for operating an illegal exchange. And just looking at insider trades in Coinbase, once again, once we see the price pop up, we always see the chairman and CEO Brian Armstrong sell into that. We can see that back here in February, sold $3.5 million worth of stock as we propped up, again in March and again in June. He is constantly selling into this. So if he's so confident in the future of Coinbase and the price is pretty depressed where it had been back in 2021 when it first came onto the market, I mean, we were up in the 300s, and look how much it's come off. And then the chairman and CEO continues to sell stock every time we pop up here to these levels, including back here, and maybe he's been selling today. We won't know for at least a few days whether he has or not. However, that's hard to have a lot of confidence in the company and stock when the top insider who knows the company better than anybody else continues to sell into all these pops here. So if the SEC does reject the BlackRock application and the others, Coinbase should absolutely fall apart here, as that's why we've seen the run up in the stock is based on that news. So I'll be keeping an eye on that one. And that same sentiment extends to the price of Bitcoin itself. So we've been consolidating at this big resistance zone here around 30,000. I'll take you out to the weekly chart. This is a price where Bitcoin has turned before. And again, it's been going up on that news that the largest investment houses in the world are trying to launch a spot Bitcoin ETF. So we sold off a bit today on that news. However, it appears to be dip bought really quick and is just holding here. And so I'd say the market will be following this story really closely, whether the SEC is going to approve those applications or not. So Bitcoin might be in a bit of a wait and see mode. However, technically it still looks strong. It's holding this consolidation zone. I still wouldn't be surprised if we see a rip above 31,000 over the weekend. Another top performing asset class so far this year has been Japanese stocks, with their best first half performance in a decade. And that was coming off a low base with low valuations, and we saw Warren Buffett take advantage of that as well, investing in 5 Japanese companies and recently increasing his investment. And so just looking at the Nikkei 225 index, it's kind of the Japanese equivalent of the SP500, and we can see that has ripped up 30% year to date. However, let me just take you out to a monthly chart and show you the long-term performance of the Nikkei. So believe it or not, it's still below its all-time high that it reached back in late 1989 when the index got up to almost 40,000. And this is a great lesson in market history. So for over 30 years now, the index has been underwater, and it took about 20 years to reach its maximum drawdown of 80%. And some people compare the price action and valuations of Japanese stocks, which were priced for perfection back in the late 80s, to what the NASDAQ is today. So here's a look at the price action of the 20 years prior to that 1989 peak in the Nikkei 225. And we can see in that 20 years, the price ran up over 2,000%. And a lot of investors will tell you from back in that time, Japanese seemed unstoppable, becoming the world's largest economy. They seem to have perfected capitalism and all that new paradigm. However, after that sediment and peak was reached, that's what the next 20 years looked like in their main stock index. And you know what else they did in that time? A huge amount of stimulus, quantitative easing, and the government exploded their debt, kind of essentially turning it into a zombie economy. And so it's of no surprise that it's bounced back. It's just coming back to a bit of a return to the mean in the long term. And I think Warren Buffett recognized that earlier in the year as well when the index was still pretty low. So here we are today on the NASDAQ index, and over the last 20 years, similar performance to the Nikkei. It actually got up over 2,000%, 2,400%, and similar valuation levels as well, similar sediment, and a similar macro backdrop with the US government exploding their debt to GDP. Current national debt at 32 trillion and the Fed's balance sheet at 9 trillion, following a similar path of the Japanese government and central bank from the late 80s into the 90s. However, if you look around in the media, a lot of people are just saying this is the start of a new bull market. AI, blah, 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 everything else is going to take it double, triple. Just keep loading up on call options and you'll be on the road to nirvana. However, I, for one, am not buying into that story because I know throughout all my academic research and study of history of markets that valuations do matter, even though in the short term the market does a great job at pulling the wool over your eyes. Okay, so just taking you through the rest of the charts today, we do have international stock indices perking back up again. Here's Canada's TSX back above the 50. Bit of a bounce in the FTSE, the DAX as well. There's the Nikkei stalling out a little bit on some bearish divergences. Aussie 200's kind of still tracking sideways, and the China 50 still pretty weak as well. There's a look at the VIX index right on its knees at 13.5, and even volatility is coming down as well. So volatility pricing isn't moving around much, but the price of tail risk insurance is increasing with the skew index almost at 150. And just taking out to a weekly chart on the skew index. So how it basically works is the market will kind of price in an upcoming correction or crash by increasing the cost of those out of the money put options as expressed by the skew index. So before we go down, the price of that tail risk goes up. And then when we get the correction, crash, bear market or whatever, then the price of those out of the money put options will come down. So you can see here in mid-late 2021, as the market was ripping up to highs, so was the skew index, the price of those out of the money put options. Then as the market corrected, so did the skew index. And looking back over the last decade, we are pretty elevated here at 150, pretty much the top of its range. We're only really beat by that in mid-2021 when things got really crazy. Short-term breadth as well is getting pretty elevated here, 78% of stocks above their 20-day average. We do have long-term breadth holding up as well, 62% of stocks above their 200-day average, however still well off the 2021 peaks when we had well over 90% of stocks above their long-term average. And a bit of a breakout in stocks making new highs today on the NYSE, 191, and same with the NASDAQ. 100 stocks making new all-time highs. There's a look at the growth versus defensive sector spread and growth versus value stocks. Still pretty elevated here, but stalling out a little bit. Bit of a pullback in smalls versus bigs, and a good indicator of upcoming global economic activity. That's the copper versus gold spread. And that's pretty much been weak all year. Did find a bit of a bottom in late May and just kind of hovering above the 50 here. And look at that yield curve diving back down to all-time lows. And so we've got a lot of the media and people saying now that the economy is really strong, the aggressive Fed rate hikes don't matter, etc., etc. However, the bond traders and bond market would strongly disagree. In fact, they're pricing in a hard landing, and we can see that in the inverted bond yield. That means up the front of the curve is higher, so we can see that in the 2-year bond yield at 490 and the 10-year at 384. And that's causing the 10-year, 2-year spread to be negative 105. And whenever that's gone negative, this is the best indicator that predicts recessions, as indicated here in the grey shading. So every time we go inverted, a recession is just around the corner. And so it would have to be truly different this time for us not to get a recession. And in my opinion, the Fed will keep hiking rates and keep them higher for longer until the jobs market does fall apart or something else breaks and then we look like we're going into recession, then they'll start cutting. And there's the Fed Fund futures market in December pricing in 100% chance that we're going to get another hike and a more than 50% chance we'll get a second hike by then as well. And just look at that price action in the December contract. It's going almost parabolic here, just marching higher and essentially telling us that inflation and the Fed is not done yet. Same with the price action in the 2-year government bond yield today, breaking out, getting up to 493 and almost back to those levels before Silicon Valley Bank collapse happened. And after this, a lot of people on the street were calling that the Fed is 100% definitely done. And for a while there, the bond market was pricing that as well. At one stage, only given a 1% chance we're going to see another hike. However, at this stage, it looks like it's almost a certainty they will hike when they meet on July 26. With the current probability actually at 86% that they will. We've also got a shortened trading week next week with the 4th of July holiday causing a half day on the markets on Monday, so we'll close at 1 p.m. on Monday. We're looking at those PMIs, and the big ones to pay attention to is the initial jobless claims. They had been tracking higher for the last 3 weeks, but the last print we got this week came in a bit below expectations, and the big one I'll be looking at next week is the unemployment rate. So that's expected at 3.8%. And if that were to go 3.8% or higher, then that means the unemployment rate would be above the 20-month moving average. And typically when that happens from low bases, again, just another strong indicator recession is around the corner. Got the dollar index holding steady at 102, and that better than expected economic data is helping commodities stay propped up here, along with crude just sitting above $70 a barrel. And over to stock sectors, green across the board. The only sector off today was regional banks down 1.1%. There's a look at the semiconductor ETF popping up 1.5%, but we do have these bearish divergences on our indicators. There's home builders finding new highs for the year. Same with industrials popping up here, but just taking you out to a weekly chart, we are in this all-time high resistance zone here on the industrials. And even the defensive sectors, healthcare, staples, and utilities had a good day. And there's a look at JP Morgan breaking out today, up 1.4%. You've been hearing me say the last few days, this has been creeping up and looking like it's going to break out, and we did. We broke out of these year-to-date highs today after it's been consolidating and hitting up against this resistance for a bit, and that was on above average volume as well, so this thing might have a little bit of legs in it, especially with higher rates, which is good for the banks. Let's look at Tesla just popping up a little bit here today on a small range, and again we've got these strong bearish divergences. Similar story in NVDA, hasn't found new year-to-date highs like we saw in Apple, which is the strongest of the pack. A little bit of a bounce up in Microsoft, Amazon near highs, but Google still underneath its 50, and Meta climbing up towards its highs as well. Bit mixed in the meme space today. There's Virgin Galactic coming off hard again, down 8% after they just launched their first space flight on Thursday. There's a look at Nike after disappointing earnings yesterday, build up in inventory. Stock came off a bit today, and the cruise lines continue to rip hard. Look at Carnival up 9.7% today on huge volume, 115 million shares, more than twice the average daily traded value, and that's on the back of their earnings where they came out with record bookings and deposits. RCL was up a little bit, 2.1% on that, and one of the leaders in the stock market this year, SMCI, had a good day, up 5%. And there's a look at the regionals, which all pulled back a bit today. Same with the big guys, a little bit soft, with Charles Schwab down a little bit. Okay, that's it for the day, the week, the month, the quarter, and the first half of the year. Thanks very much for sticking with me through this longer video today. I'm continuing to remain market neutral for all the reasons I pointed out in this video. I still think we're near a short-term market top. However, there's so much momentum in the market, especially with that price action in Apple today, that could easily spill over into next week. However, long-term, I'm still dubious on this market, as I pointed out earlier, especially on the NASDAQ, with the huge run-up we've had over the last 20 years and current valuations. That's why I'm hedging my long-term positions with short-term short positions, as I don't want to be left holding the bag when we do have that inevitable correction or crash. However, right now in the short term, we've got to respect that momentum, and I don't want to fight it too much, so I'm going to stay market neutral. And finally, this is my last call for anybody interested in getting lifetime access to all of my custom indicators and any ones I bring out in the future. Like I said, I put hundreds of hours into making these indicators. I use them myself, and they allow you to look and analyze the market in ways that just the basic free ones out there can't do. And with all the new data available and the flexibility of the TradingView platform, it's allowing for some truly cool indicators to be created, and I have some really exciting stuff in the pipeline I'm looking forward to sharing with you guys. And so this is the best deal you'll get, $197 one-time fee, no ongoing costs. You'll get all 20 of my indicators, any future ones, plus my ongoing support. And if you decide they're not for you, no worries at all, 7-day money-back guarantee. So head on over to clickcapital.io/deal. I'll put the link in the description of this video, and take advantage of this special offer, 50% off. That's only for the next 2 days to midnight Sunday New York time. Then after that, this page will disappear and the price will be back to $397 for anyone going forward who wants these indicators. So take advantage of that. You won't regret it, and I look forward to sharing all my private custom tools with you. All right, guys, that's it. Have a great weekend, and I'll see you again next week.